Let's turn now to that weaker than expected jobs report because we learned payrolls grew by just 114,000 in July, way below the 185 estimate. The unemployment rate jumped to 4.3%. That's the highest in nearly 3 years. Let's get some reaction from Corey Kantega, senior economist at LinkedIn. Corey, now that we've had, 6 hours to digest it, what are your conclusions?
Well, if we got a jobs report like this a few years ago, think like 2017, 2018, the response would have been something like, meh. But now, with this jobs report post-pandemic, here we see people running up the tower, ringing the bells. I think there are two things that we need to know from this jobs report. The first thing is that the window to a soft landing looks a lot smaller this week than it did last week. So we are likely to see a conversation about the Fed cutting rates in September. The question is how much. The second thing is that we've seen the labor market slowing down going into the summer. So if you were banking on riding a resilient labor market to 2% inflation, you probably have to rethink that now.
When you say the question about September may pivot away from whether or not they're going to cut rates, but by how much, what would a 50 half-point cut mean? What would it signal?
So right now, I don't think the Fed is necessarily signaling whether it'll be 25 or 50. What we should expect to see is that there won't necessarily be a big bump from the Fed cutting rates now. A lot of that's already going to be priced in, and businesses are already taking stock and making their hiring decisions ahead of time. So we're not necessarily going to see a pickup in the labor market immediately.
But a half-point cut is not priced in.
So for some folks, they're probably pricing it in now. Right now, I think if we start to see that getting priced in later on, because there's going to be some signals coming from Jackson Hole at the end of August. So by the time we are in September actually looking at rate cuts, that could be priced in and we could be having a different conversation.
How weak do you see the labor market being and getting?
So right now, the labor market is showing some vulnerabilities. That's very clear. And there are some very particular vulnerabilities that I'm paying attention to. One, skewness in job growth. Most job growth came from government and healthcare, over 70%. Those areas still have some runway to grow. So it's not like we're expecting a negative payroll number anytime soon. But there's also other vulnerabilities, and that has a lot to do with hiring. So hiring hasn't picked up. In fact, it's slowed down coming into the summer. And we're not going to continue to see unemployment remain contained if people can't find work.
So on that front, Corey, when we talk about kind of what the Fed should do here and whether they, in retrospect, should have cut on Wednesday, what are their best options now? TD is now calling for a 75 basis point cut in September. Some others are now at 50, and many who didn't think we were going to get a cut are now at 25. What do you think would get the best outcome for the economy?
So I think there's something that's been very much overlooked that we have to keep in mind, and it was flagged in the Fed statement this week. And that's that they're looking for price stability over the long run. So what would be a particularly worse outcome for the Fed is if they cut rates and then inflation went back up and they found themselves having to go through another tightening cycle. That for the Fed, that might be the worst of all worlds because we're already seeing some vulnerabilities in the labor market. Hiring is slow. There's not a lot of churn. And then in order on top of that to have to raise rates again to slow things down even further, that would be kind of a bad outcome for the Fed. So that's something they are really keen on, and that's why they want to see more inflation data. But I think that balance is kind of tilted now. They're looking more at the labor market. They're paying closer attention.
That did seem to be sort of the subtext of the statement on Wednesday and Chair Powell's commentary about it. As you look out toward the end of the year, how many rate cuts are you expecting?
Well, right now, I wouldn't be surprised to see a couple of rate cuts, one in September, one potentially in November and December. That seems to be where the Fed has been signaling recently. And unless we see something change in the labor market or elsewhere, I would think that's the path the Fed's going to follow.
All right, Corey, thanks very much. Corey Kantega, LinkedIn. Thank you. And still to come, Apple's surprising analysts topping sales estimates. We will break down the numbers next. That's a reversal there of the past. As we head to the break, time for today's power check. Leading declines on the S&P. That would be Intel. On the positive side, you got GoDaddy Holdings. That's your power check. We'll be right back.
Welcome back. Big verdict for Apple. It's positive, not just today and after what's happened with big tech earnings in general, but especially with this market tape right now. It's up almost 2% after a top and bottom line beat last night. Let's get to Steve Kovac with the details and why, Steve, it remains somewhat immune here.
Yeah, Kelly, and also I should note after hours yesterday, the stock was down as much as 2.5%, so a big reversal there. But look, the story here, Kelly, is Apple is growing again after reporting sales declines in 5 out of 6 quarters. Sales were up 5% for the June quarter. And that's going to continue. The company says to expect similar top line growth for the September quarter that we're in right now. But that growth likely isn't going to come from the iPhone. Services is picking up much of the slack. Apple said it'll have another quarter of double-digit growth for the services segment. Everyone's looking to the iPhone 16 cycle, though, of course, which the street believes will see a big upgrade boost with the launch of Apple's AI features this fall. I caught up with CEO Tim Cook on the results and asked him what demand signals he's getting following the AI announcement back in June. He said it's not really going to be clear until Apple AI actually launches, but he did say he thinks it's going to make a compelling reason for folks to upgrade their iPhones. Beyond that, China, of course, is a big downside here. Sales were down 6.5% on the quarter. For the quarter, rather. The AI launch there will be important since Chinese customers tend to buy when cool new features debut. But it's not going to be easy for Apple to launch AI out in China. The government needs to give its blessing first. I also asked Cook about that AI rollout in China. He told me, quote, "We're working on exactly what we will do there, and there are definitely regulatory questions there that we have to respond to, and we're working constructively on those." So, Kelly, it's going to be a while before we see this AI really hit the global markets, but at first just going to be here in the U.S.
Right, indeed. And again, it's quite a verdict. I mean, Steve, people are asking now as they look through, sift through the damage, what are the safe havens amid this broader pivot that we appear to be in? And today it seems like Apple could be one of them.
Yeah, that's exactly right. And that's exactly where we're seeing the money has to go somewhere, I guess. It looks like it's going to Apple. And look, it was a good quarter. I mean, they did beat in the top and bottom line, showing growth again. I mean, after all that sales declines we've seen just coming out of COVID, the economic situation in China is still dragging them down. But the services resurgence is really helping them a lot. Double-digit percentage growth. The App Store is just on fire right now, plus just so many subscriptions going through. And also, I would just note, I asked CFO Luca Maestri yesterday on these earnings, too, about those regulations in Europe, the Digital Markets Act, that could impact the services business. It doesn't seem like there's much going on there as far as a negative impact, but they're still working through with those regulators to figure out how to comply.
All right, Steve, thanks very much. We'll see you when you get back. All right, let's move on now to another tech company facing its own challenges, Amazon, getting crushed following its results. Revenue did jump 10% to $148 billion, but that was a little bit shy of what analysts were looking for. Let's get to Kate Rooney now with more on what's going on Amazon. Kate.
Tyler, so Amazon is the biggest laggard right now on the Dow. The consumer side of that business, so e-commerce is really what has Wall Street worried today after yesterday's report marked the first time Amazon's revenue guidance has missed in almost 2 years. Profit outlook also came up short, and then online sales did slow to 5%, down from about 7% in the prior quarter. CEO Andy Jassy on the call with analysts called the consumer cautious, said folks are now trading down to lower priced items, but did argue that faster shipping for Amazon is giving them a bit of an edge. And then as RBC put it in reaction, the concern from here likely switches from that AWS reacceleration, that cloud growth, concerns there, to views of a softening consumer, effect on margins, and rising CapEx intensity. They joke, where have we heard this before? It's a theme throughout big tech. One reason for the choppy forecast, the CFO told us on the media call that consumers are distracted by the news cycle. The Olympics, for example, and the attempted Trump assassination are causing people to defer sales, said it's going to make it hard to forecast this current quarter. And then advertising growth did slow sequentially. Executives said it's coming off a larger base at this point. They highlighted that as a bright spot with Prime Video ads now rolling out. And then those concerns about the consumer slowdown, they did outweigh some of the cloud growth, which really was a bright spot. AWS revenue was up 19%, better than expected. AI and CapEx took up a lot of the oxygen on that earnings call. After spending $30.5 billion in the first half of the year, Amazon now expects capital investments to be higher in the second half of the year. The majority of that spending is going to go to support the growth needed for AWS and infrastructure. as well as AI, guys.
Make it simple for me, Kate, in terms of what Amazon's real core businesses are. One is the consumer business. Two would be AWS. And three, it would seem to me, would be the growing future in AI. All of the other stuff that they're in, whether it's Apple Prime and streaming and so on and so forth, seems almost like rounding errors to me.
Yeah, well, there's also advertising, which is a growing part of really the bull case, but it goes back to Apple's origins and founding. That's the core side of the business. E-commerce, them selling things online. It's a lower margin business. It's kind of, you can think of grocery stores and normal retailers. That's really what they're known for. And when most people interact with them, you've got the Prime subscription business, which is a part of that. And their whole bid has been, all right, we want people to stay on our platform. They're shopping with us, but they're also, that helps the ad business. They're buying these subscriptions, and so they call that the flywheel effect. And then AWS really sprung out of nothing from Amazon. It was built and is now the higher margin, really higher growth side of the business. So it's kind of, you can think of it as sort of these two parts. But one way, I was thinking about this analogy. I'm not sure it's a perfect analogy for the quarter, but if analysts and investors were going to give Amazon a hall pass on spending, you saw this with big tech, they've got to really nail it on their core business. You saw this with Meta. They're going to have to nail it. It's kind of like your parents saying, okay, you know, if you do your homework, you can go out and play with your friends. If you do your homework in the case of Amazon, if you're really nailing it with e-commerce, you can go out, we'll give you a hall pass, we'll let you go, you know, spend big on AI and do all this CapEx. That's really what they were not able to accomplish in the quarter. So that's kind of the analogy I'm going to go with.
Yeah,
I love that's a great analogy.
Yeah, didn't stick that landing particularly
that
well,
one too.
as Ron said earlier. All right, Kate, thanks. Kate Rooney.
Thanks, guys.
And after the break, another key tech name going in the opposite direction. Intel sinking big time after missing on guidance, cutting its workforce, and cutting the dividend. We'll break down all the chip stocks next. Don't go anywhere. Welcome back to Power Lunch. Shares of Intel are having their worst day since 1974, falling 26% after poor earnings. Joining us now is Vivek Arya, who covers semiconductors at Bank of America. He downgraded Intel this morning, saying they're not equipped to compete with NVIDIA and AMD, and there are no easy or quick fixes for their problems. And he joins us now. Vivek, it's great to see you. And I mean, again, this is not like down 26% off an all-time high. The shares were down 40% going into this, and it's been, I think, on like a 4-year slide.
Thanks, Kelly. I think what's going on is a mix of both the industry factors and then some company-specific factors. From an industry side, yes, demand for AI is very strong. But when you go outside of AI, the demand, whether it's in the enterprise environment or telco or industrial or automotive, is not really doing that well. And Intel's presence kind of exposes them to a lot of those cyclical factors. So there are industry forces at play. But in the specific case of Intel, I think in some ways it's a classic case of innovator's dilemma. The company did everything right for nearly 4 decades when it was the leader in PC and server CPUs. It kept on making them better and better. But I think that in hindsight made them miss the mobile cycle. It made them miss this move in the industry towards a fabless and a foundry model where either you are focusing on manufacturing or you're focusing on design like most of their competitors are. And more recently, I think it made them miss the whole AI cycle where there is a shift from serial to parallel processing. So I think they have suffered from a combination of both industry and company-specific factors, and this thing is not going to turn around very quickly. We do think we might have to wait till 2026 to see any tangible signs of progress.
This is obviously a Harvard Business School or anybody, pick your business school case waiting to be written because there are many, many, many companies that have had exactly this kind of phenomenon that you describe happen to them. What is the fix here, or is there a fix here?
So what I think Intel still has going for them is they do a very strong brand name. They have a lot of very good US-based manufacturing assets, even though they are not up to par in terms of the technology that Taiwan Semi has. You know, they are 1 or 2 steps behind. And then, of course, they have a very strong position in the enterprise. They have a very strong position in the PC market. So Intel does have a few things working for them. The challenge is that the spending in the industry, the broader demand environment is soft, and a lot of the spending is shifted to AI. And AI requires a very different kind of investment in silicon and systems and software. And I think NVIDIA had this vision a decade ago and has been working at this for a decade. And that's really hard, not just for Intel, by the way. I think it's been hard for everyone else in the industry to catch up. So we do think that, Intel stays a player in the industry, but the time for it becoming relevant again, I think that time is going to be difficult to get back to.
I was just going to say, Vivek, that I think this is a good reminder if we hadn't had AI, what the economy and the business cycle might look like, because the semis are a poster child of someone that's swung from shortages to gluts, much like we're seeing in autos now and so forth. What were their gross margins at peak of the last few years, and what are they now?
Sure. At its peak, Intel's gross margins were over 65%.
Wow.
Now they are 38%.
Wow.
Right. As go gross margins, so goes Intel. And, gross margins are a very important indicator of pricing, of value capture, of differentiation, of execution. And just to put it in context, NVIDIA's gross margins are 75%, nearly twice that of Intel. And by the way, those gross margins are after paying Taiwan Semi to manufacture products for them. So that's the extent of distance that NVIDIA has put between themselves and Intel.
You listed some of Intel's various assets, the things that they do have going for them. But how do they deploy or use those assets to get back to where they'd like to be? What is the path out or forward?
Sure, Tyler. I think some of it is macro in nature also, that as we, there's a reason everyone is clamoring for rate cuts because the broader demand environment is not that strong. So as and when we do get that cyclical pickup, next year, for instance, there is the end of life of Windows 10. So many enterprise CIOs might be encouraged to upgrade their laptops. So that can certainly help Intel. If, let's say, there is a geopolitical situation in China and Taiwan, Intel's US-based manufacturing can grab more market share. More recently, we saw, for example, when there was a strike, when there was an issue with CrowdStrike, a lot of Intel-based laptops with their vPro product were able to actually come out of that issue very quickly. So Intel definitely has assets that work for them. But the big picture thing is that they are trying to simultaneously compete with the best designers on the planet, which are AMD and Broadcom and NVIDIA and Marvell's of the world, and trying to compete with the best manufacturing entity, which is Taiwan Semi, and trying to run both a marathon and sprints at the same time. I think it's just very difficult in this industry.
A 30-point collapse in margins. I mean, they've come back from something like this before, or is this just completely different this time because of the competitive pressures?
I think it's tougher this time around, and the irony is that their PC business, as much as there can be a recovery in demand for their PC business, because they fell behind in manufacturing, a lot of their PC chips are actually being manufactured by Taiwan Semi.
Yeah.
So as a result, there is a higher input cost, and their own internal fabs are less filled, and that's another reason why we see that gross margins. Because if you look at Intel's Q2 sales, they were in line with expectations. The big miss was nearly a 500 basis point delta in gross margins because of this shift in where it's being produced.
It's fascinating. Vivek, thanks for helping illuminate their problems today. We appreciate it.
Thank you.
Vivek Arya.
All righty, as mortgage rates begin to fall, will housing find itself on a firmer foundation? We will discuss that ahead on Power Lunch. Be right back. Welcome back to Power Lunch, everybody. Oil falling more than 3% today. Economic worries supersede, a big word there, geopolitical tensions, which had sent oil higher earlier in the week. Also heard from the two biggest oil companies today, Exxon and Chevron, reporting results and painting two very different pictures. Pippa Stevens here with more details. A lot going on here.
Yeah, it's interesting because they're in the same operating environment, but we did hear two very different things. And Exxon was higher earlier in the session, which is notable when basically everything is down. It has since given up those gains, but still. So starting with Exxon, they had a top and bottom beat that was driven by a huge amount of strength in U.S. upstream. It was 40% above expectations. Their downstream was a little bit weak, but we've heard the same thing from others like BP and Total, and that was overshadowed by that upstream strength. They had record production in both the Permian and in Guyana. But not the same here with Chevron. We saw a bottom line miss for them, and they had their U.S. upstream was good, but their international upstream is what missed expectations. They gave a whole lot of reasons for why, including the lack of tax benefits they had last year, as well as FX impact and then lower natural gas realizations. But then, of course, as RBC said, the elephant in the room is Hess, and that's what's really weighing on the company right now. Those shares, we heard earlier in the week that the case is not going to be heard until May of 2025. So that's a lot later than they thought. And so if that deal goes through, the earliest would be at the end of next year, end of 2025. So that is 2 years after they initially announced it. So that is a huge opportunity cost there, a huge unknown. And Hess's Guyana stake was seen as a real beacon for Chevron. And so if that's called into question, it's hard to see how Chevron could outperform here. And then finally, one quick talker, Chevron is officially moving its headquarters from California to Texas. They already had about 3/4 of their employees there, but still, it's a pretty notable shift. They were in California for nearly 150.
Right? Yeah.
San Ramon, like close to San Francisco.
Yeah.
They were there for nearly 150 years.
Wow. I was going to say that almost felt like the elephant in the room, too. Did they go into much detail about it, about California politics or policy? Or?
Exactly. So Becky Quick on Squawk Box asked Mike Wirth about it earlier, and he said that, we've been very clear that we think policies that raise costs, that put supply reliability at risk hurt consumers, but the economy at risk in California is discouraging investment in the energy that runs its economy. Wow. So some pretty harsh words there. And they're not the only one to leave California.
No, but everyone goes, it's Musk. When it's someone like Chevron, I think you take a little bit more notice.
Yeah.
It's interesting. Pippa, thanks. Pippa Stevens. Let's get to Kate Rogers now for that CNBC News update. Kate?
Hi, Kelly. The Pentagon said this afternoon the U.S. will make changes to its forces in the Middle East to support Israel as tensions boil over following high-profile Hamas and Hezbollah killings. According to a spokesperson, Defense Secretary Lloyd Austin called Israel's defense minister today and reaffirmed U.S. support and informed him of the changes. Pentagon officials didn't go into detail about what the changes would be, but said Austin is making a decision on deploying additional forces to the region. Meanwhile, a bipartisan group of senators introduced a bill that would end the military draft in the United States. It's not been used since the Vietnam War. It comes as lawmakers have disagreed over whether to add women to the draft after the Defense Department opened all combat roles to women in 2015. And Harvard announced today its interim president, Alan Garber, will remain as president of the school through spring 2027. Garber was appointed to the position in January after his predecessor, Claudine Gay, resigned following backlash over her response to anti-Semitism on the Harvard campus, as well as Mount's plagiarism allegations. Kelly, back over to you.
Wow. All right. Pippa, she said. Kate, thank you. Kate
you.
Rogers. Homebuilder stocks are down across the board today. Could the drop in yields and rates help spur more activity? We will speak to an industry insider about that when we return.
Hi, welcome back to Power Lunch. Bond yields falling after a weaker than expected jobs report. The 2-year yield hitting its lowest level since last May, and the 10-year lowest since December. But that is also bringing mortgage rates down just a bit. The 30-year fixed falling to 6.4%, lowest level since April 2023. This according to Mortgage News Daily. Here for more on the impact on prospective home buyers and refinancers, Andy Walden, Vice President of Research and Analysis at the Intercontinental Exchange. Andy, welcome. Good to have you with us. Let's talk first about refinancing, which has been sort of a dead zone for the mortgage business over the past couple of years. Does this decline in mortgage rates suggest that more people will get in and try and refinance?
It does. And you mentioned it has been a dead zone out there in terms of refinance incentive. And what we're seeing with rates falling into that 6.5% range, slightly below that, as you just mentioned, is that there are 900,000 more folks that could save 0.75% through a refinance today than there were just a couple of days ago. We're up 60% in terms of refinance incentive here over the last couple of days, just because of that drop in rates and some of the highest volumes of refinance candidates that we've seen out there really since the Fed started to raise rates in early 2022. So still modest by historical standards, but you are starting to see that activity and that incentive pick up again out there in the market.
You've got rates sort of back to where they were roughly a year ago, right?
Yeah, that's exactly right. But the dynamics of the market are slightly different than they were then. We've lived broadly in an environment where rates are above where they are today. Seen a little over 4 million loans that have been originated with rates over 6.5% over the last couple of years. And so you simply have more refinance incentive on the way down in rates than obviously you had on the way up, which is a good thing for the lending markets.
Andy, it's Kelly here. 2 quick questions. One is something that Steve and Mark Zandi and I and everyone's been talking about. How much bigger is the gap between the 10-year yield and the 30-year fixed than it normally is? And do you see any sign of that gap narrowing, which would help bring rates down even more?
Yeah, it is wide, right? And it's typically, or right now, it's about 0.75% wider than it traditionally is. It's about 2.65% as we stood here yesterday. And so, yeah, it's actually are leading to higher interest rates than you typically would expect. And the forecast over the next year or so is for that spread to reduce. So along with 10 years coming down, you should see a little bit of reduction in that spread, which should help mortgage rates as we move into 2025 and beyond as well.
But what would it take, and this is now a follow-up to the first question, but the second one, what would it take on that front and or on the 10-year front to get the mortgage rate back in the 5s?
Down into the 5s, so subtract 2.5 off of that, right? So you're talking closer to 2.5%. 10-year Treasury yield is probably what you would need, or 3.5% is what you would need. So you're going to need some considerable movement down from where we are today. You're going to need some compression of that spread. You're going to need both of those together. And, you know, when you look at the 30-year rate forecast for the next 18 months or so, a couple of days ago, we were talking maybe low 6s by the tail end of next year with the lower Fed dot plots here after the latest meeting. Now, maybe we're talking in the 5% range, high 5% range as we get into the tail end of 2025.
So here's the question that should be obvious, but I do wonder, and I wonder if you'd kind of walk with me on this journey. Are falling mortgage rates, do they mean higher home prices or lower home prices from here?
It's a good question, right? So if you look at our ICE home price index over the last couple of months, you've seen the housing market slow, right? Rates have been in kind of this high 6% range, low 7% range. You've seen the housing market slow for each of the last 4 months, and suggestions that it would cool a little bit more over the next couple of months. I think this is a needle mover. This is a game changer in terms of the way that the housing market moves. There have been a couple of times over the last 2 years where 30-year mortgage rates have been where they are right now. Both of those times have resulted in the housing market heating back up, demand heating back up, some of that supply, which has been a bright spot for the market that's been rebuilding, getting bought down. And so I would expect a little bit of a transition here from a cooling housing market to potentially a little bit of reheat here over the next couple of months, given the additional buying power folks now have.
All right, very interesting. Andy, thank you very much. Andy Walden, we appreciate your time today.
You bet. Thank you.
Still amazing to see the 10-year printing at 379 right now. And this broad sell-off in the market. Intel's lower, so are most of the other chip stocks today. But there is one name among the carnage that's perhaps a buy. We will ask our trader which one that is in 3 Stock Lunch next. Welcome back. Let's close out the show today with 3-stock lunch as stocks continue to sell off. We're looking at some of the worst performers of the week to see if there are any bargains, according to our trader. He's Scott Nations, president of Nations Indexes. Scott, welcome, and thanks for playing ball today. Let's start with Boeing shares, which are down 10% in the past week. The company reported those Q2 results showing a huge decline in revenue, fewer deliveries, that new CEO. The shares are down 35% this year. Would you step in and be a buyer here?
I would be a greedy buyer, Kelly. And by that, I mean I'm putting bids below the current approximately 168 price. You mentioned the new CEO. I think new leadership is absolutely critical. It means Boeing is turning the page. Importantly, he's a mechanical engineer by training. He's not a finance guy. He's not a marketing guy. That means that Boeing is going to refocus on engineering, design, manufacturing. He's their guy. Maybe most critically, he's announced that he's going to be based in Seattle. And you'll remember that a couple decades ago, the company moved its headquarters from Seattle first to Chicago because they wanted to be closer to international customers, and then to Virginia because they wanted to be close to defense buyers. I think it's just absolutely critical that they're back in Seattle. If there's a problem, and the reason I would be a greedy buyer is because the company has 200 planes parked in various locations waiting for parts for final assembly. That's going to be job one for the new CEO, Kelly Ortberg.
All right. Let's move on to Moderna. Those shares are down 30% or so in the last week. The company reported its Q2 revenue beat estimates and a narrower than expected loss for the period, but it did slash full year guidance. Shares of Moderna down almost 10% today. This one has been struggling. Scott, what do you do with it?
Yeah, this unfortunately is a sell. To many people, they were a hero of the pandemic. But as you pointed out, they just lowered full year guidance by 25%, losing a ton of money. Europe has announced that they're going to buy less of the COVID vaccine. It's about $86 now, but the price to pay attention to is the price at the start of 2020 before the pandemic was in full bloom, if you will. That price was $19 a share. So if you love what they did during the pandemic, that's great, but you don't have to be along for the ride all the way back down to 20.
So this would be a sell for you?
This is, yeah, Moderna's a sell for me.
Moderna's a sell, okay.
All right, let's see about Micron. Then those shares are down 16% this week. It's down 4 of the past 5 sessions, but still up about 8% on the year. What do you do with this one, Scott?
Micron is a buy. It's fairly priced with a forward PE of just 12.5. Fairly well diversified in their product line. They mostly make memory chips, largely DRAM chips, but those DRAM chips are important in AI in that they're bundled together to create high bandwidth memory applications. There's a little bit of a glut of memory chips right now, but that's easing. That's going to help Micron. The only concern for this company is CapEx. They're going to have to build 3 plants, spend a bunch of money. But I love the fact that they're solidly profitable and relatively well diversified across the chip space.
We have our buy. It's been a tough week. So broaden it out, Scott, over the weekend. What kind of homework are you going to be doing? Are you stepping in here to say this is too much of a growth scare and it's time to get positive on stocks? Or is it time to move to the sidelines or rotate?
Well, there's lots of concern because we have slowing growth and we still have a substantial amount of inflation. I'm old enough to remember when everybody talked about stagflation. That's a concern. One thing that really jumps out at me is that we calculate and publish an index, TDEX, Taildex, which measures the cost of crash protection. And it's jumped more than 100% today alone. It's only done that 6 other times since 2005. So people are finally getting the message that stocks can go down, and they're just desperate to get protection right now.
Where would you, if you were a defensive-minded investor, where would you go?
I would go to consumer staples, particularly the biggest names with the most pricing power, the strongest brands, because they are going to have to not only continue to sell a bunch of stuff during a slowing economy, they're also going to have to do well in the face of inflation. So if you're somebody like Coke and the average cost of the product is $1 and you have pricing power and great brand equity, that's going to do really well in relation to the broad market. Another one would be Procter & Gamble, same sort of setup, wonderful brand equity, relatively low-cost product, and the ability generally to maintain pricing power in the face of inflation, you really would have to have a strong stomach to step into the tech space or AI space right now.
Only quick comment on that, Scott, as I see some of the CPG, consumer packaged good companies, still retrenching from inflation. They have disinflationary pressures, but the market is speaking. And certainly Coke is cheaper than a bag of chips, to go back to the discussion point we've been having for months now. And then on bond yields, quickly before we go, look at gold's breakout.
Yeah, I think bond yields, they certainly were falling on slower economic growth, but right now much of it is a flight to quality. People are just buying bonds, but they're not worried about the return on their investment, the return of their investment. Yeah. So there's a flight to quality right now.
All right.
Very interesting. And we go into the weekend after a very busy, thank you, Scott, by the way, very busy week. Fed meeting, obviously lots of earnings reports that have been sort of spotty, patchy, I guess I would call them, and the jobs report today.
Indeed, I will see you at 6 p.m.
We have a special.
We will have some live coverage. Looking forward to it on the market sell-off. And Closing Bell starts right now.
All right, yes, it does. And welcome to Closing Bell, everybody, on this Friday. I am Brian Sullivan, and for Scott, really a make-or-break hour. It's why we had the fancy breaking news animation there at the top. You've got a big sell-off in stocks. New fears the American economy may be about to roll over a bit. The weak July jobs number, another downward revision for the June number, putting the Fed back into play. And some on Wall Street sort of loudly wondering, did the Federal Reserve make a mistake by not cutting rates on Wednesday? We're going to be joined by former Federal Reserve Vice Chair Richard Clarida. We'll ask him that and more about the economy coming up. You've also got a concerning Amazon quarter, consumer coming in a little bit weak. And get this, Intel is having its worst day since I was 3 years old, and the Brady Bunch was a hit on television when they were still cute. We're going to speak with an all-star analyst who says the stock is, quote, unownable right now. And we'll talk about whether or not Intel could maybe go out of business. Not me, him. All right, rough day for the money. Here it is. Here's how things look. An hour to go. If you're looking for upside, and we always are, the Dow is off its lows. We're down 768 points, about 1.9%. S&P, worst session in roughly 2 years, but off the lows. NASDAQ now down more than 10% from its high, so technically they call that a correction. You got small caps, you got regional banks taking big hits as well. All this as buyers really flock into bonds, setting 10-year yields well under 4%. And then this, to me, this is the most interesting chart of the day. It is the so-called fear gauge, CBOE, volatility index, measure of bonds, et cetera, or options. It is having one of its biggest moves ever as the market really completely reprices pretty much everything. This all takes us now to our talk of the tape, how aggressive the Fed might have to get, what it means for your money, where do we go? A lot to discuss, so I'll shut up and we'll jump into it. New Edge's Cameron Dawson on set with us here, and Truist Keith Lerner also joining us remotely. Good to see both of you. Big day, need a steady voice. Cameron, first to you. The jobs number wasn't that horrible. It feels like, we brought this up on the noon show, a little bit of a market overreaction.
Well, 114,000 really isn't that bad in the grand scheme of things. It depends on what you think the neutral number of jobs should be. If it's 150,000, 114 isn't bad. If you think we should be closer to 200 to 300,000, then that 114 is pretty bad. If we think about this reaction, we can't forget that there's a lot of positioning happening here. And that positioning unwind is likely why this move is so magnified.
Yeah, because, and I think Cameron nailed it, Keith, because I've been doing this a long time, my man, you know that. And yeah, we slight miss on the jobs number, and the market does what it's doing. That, to me, is not about the jobs number or the Federal Reserve. It's what Cameron said. It's about positioning. It's about hedge funds. It's about this yen NASDAQ carry trade unwinding. If I'm wrong, tell me, would you agree?
Well, first, Brian and Cameron, great to be with you. My head's spinning with all these different cross currents in the market right now. I do think it is somewhat of an overreaction. You said you've been doing this a long time. I've been doing this a long time. The jobs report day tends to be an overreaction, and you also have to look at the trend because this number is revised 1, 2, or 3 times. If you look back over the last 3 months, Brian, the average job growth is about 170,000. That's close to the pre-pandemic trend. But also, we have to realize we had a big first half in the market. as Cameron mentioned, positioning was a bit stretched. And even after you have that big first half, the second half, you tend to see gains, but there tends to be hiccups along the way with an average pullback at some point of about 9%. So I think we're in that corrective period, but we still think the bull market trend is intact. It just is going to take a little bit to get through this kind of choppier period. And
you had noted, Cameron, to me that all these sort of technical traders, right, they were all long. Yeah. It's like 99.9%. That's almost all of them, 99.9%. They were all long. They got to unwind that. And you pointed out, and this is fascinating, that the markets today sold off almost perfectly to their 50-day moving averages.
Yeah, 50-day or 100-day moving averages, depending on what index you're looking at. So you look at the Russell 2000, corrects to its 50-day. S&P 500, right to its 100-day. The SOX index, semiconductors, right to its 200 days. So the biggest test next week is how we react off of this moving average. Do we bounce off of that, or do we drift lower, meaning that this correction is deeper and more protracted? We really can't judge that until we start to see this bounce, but we would note markets aren't technically oversold yet, which would say that maybe there is some more churn to come.
More churn to come. Listen, it's a traditional day, and I know it sounds weird, Keith, to say that. Gold is over 2,500. The utilities are up. Apple is up. People are kind of looking for safe places. I won't say safe haven because that's actually redundant. Safe haven. Safe places to put their money. Do you expect that to then be unwound and we go back to, quote, normal at some point here, Keith?
I don't know if we're going back to normal. I don't even know what normal is. I will say we in our portfolios, we added gold a few months ago, and we think it's going to be a good hedge because geopolitical risk is rising. There's uncertainty about the U.S. dollar. It just made a new high. Technically, it looks great. So in moderation, we still think that makes sense. We're actually overweight utilities as well. But listen, Brian, I think this kind of corrective period, there's two components. There's a price component and there's a time component. I think both of those have a bit further to go. I mean, one thing we'd be watching for is following tech. You know, tech let us down, and often when a correction has run its course, you'll see the leadership or you'll see what brought you down start to bottom. We haven't seen that yet. I think what's also notable, 2 weeks ago, everyone was talking about, hey, small caps has had the best, 5-day change we've seen in history, or one of the 5 best. We're back at the breakout point, that CPI day as well. So I'd be watching that over the next week as well, seeing if it can find some support. But ultimately, we do think the market will eventually recalibrate and move higher. I just think in the near term, it's hard to say what the catalyst is, right? We're moving past earnings season. The Fed's in a bit of a pickle because the next meeting's not till September. And then we get into this kind of seasonal period, which maybe in the election period gets a bit, yeah.
Well, I'm not disagreeing with you, but the Federal Reserve can cut anytime they want. I mean, they don't have to do it at meetings. They've made intra-meeting changes as well. So, A, do you think they screwed up by not cutting this week? And B, I mean, they could next week to say, oh, you know what, we're going to cut. They can do that.
Yeah, well, listen, I'm not one to second guess the Fed. My question today, and I've been asking around, did they have this report on Tuesday or Wednesday? I've gotten mixed answers on that. But listen, if they cut intra meeting, I think then the question becomes: are they overly concerned? The market may take it that way, as opposed to being patient until September.
As like a sign of panic.
Yeah, exactly. So I don't know that. I mean, I don't know that they're going to do it, and I don't know that the market reaction would be as positive as we think.
Yeah, we heard from Austin Goolsbee today, and it's like he read The Hitchhiker's Guide to the Galaxy that says, don't panic. He effectively said this is just normalization and that we won't read into one data point, which just says this doesn't seem like a Fed that's going into the situation room trying to figure out how they could stall the bleeding. I don't think that they're looking at this 114,000 and saying this is something we need to panic about. And if they did, it would be probably a bigger problem for the market because they would extrapolate that 114 goes to 50, goes to 0, goes to negative in payrolls, which would be a big problem for GDP and growth.
I mean, we're showing all these stocks, Cameron, right? And I get Amazon. They had weaker consumer numbers. Intel, its own story. We'll do more on that in a couple of minutes. But, Micron is down. They make DRAM. It's a commodity product. Like, people are going to buy computers. They're going to buy things with DRAM. Micron's down 10%. Prudential Financial, probably on the bond move, down 10%. It feels like everyone's just kind of dumping everything. And they're going to take the weekend to kind of reconsider what they want to rebuy.
consider the starting point about how overbought things were. And so there is still this aspect of the bigger they are, the harder they fall. The more you were extended and overbought, the more room there is to correct, because valuations were also very extended. But to your point is that the big question from here is that do you see these kinds of moves translate into earnings revisions starting to trend lower? That's been the key thing that's been underpinning this market, is continuously rising earnings revisions.
Well, answer your own question. Is this going to translate into revised earnings?
I think 2025 numbers are too high.
Okay.
And maybe this data is the spark to get people to start moving estimates lower. 2025 numbers have a huge amount of acceleration in the top line and massive margin expansion. If inflation's fading, neither of those two things happen, which is why we think 2025 estimates do need to come down. And it suggests that as we move into next year, we're looking more at a sideways kind of choppy market versus this unflinching up and to the right.
Yes, and Keith, I know, Bill Gross, he's a friend of mine. He's known as the original bond king, but now he can just do whatever he wants. And he tweeted out something interesting today, as he is wont to do. Bill said, is any media figure willing to say bear, meaning bear market, bear? Bill, I'm in the media, I just said it. But he says very few bull stocks these days, pipelines, banks, financials in general. And this is, I want you to comment on this. Investors should stop talking about buying the dip and start asking about selling recoveries. What do you think?
Interesting. I gotta think about that one a bit. At this point, I mean, our baseline view is that the bull market is still intact. So we would still be saying probably somewhat of a deeper pullback that you still want to buy the dip. I think some of this kind of economically sensitive trade that we had up until this point, I think that's questionable in a cooling economy, like going back to the small cap trade, even though we're more neutral. In order for that to really do well, you need an economy, historically at least, to have some momentum. So the way we're thinking about it is we're looking actually with tech. We think it's premature. We downgraded tech at the end of June. We're looking for an opportunity later this year to re-engage because we still think that's the secular story. So to answer your question directly, Brian, we're still looking for buying the dip. We're just not buying the dip yet.
Not yet. That word "yet" is always such an interesting word. Yet. Keith Lerner, Cameron Dawes, thank you both very much. Have a great weekend.
Thank you.
All right.
Thanks, Brian.
In the meantime, we talked about it a moment ago. Intel on pace for its second worst day ever. In fact, in more than 50 years as a public company, Intel's only had one other day worse than this, and that was in 1974. Just gave away my age, but it's on the wiki thing anyway. This after investors, or Intel saying it would suspend its dividend, and it would lay off 15% of its workforce as part of its costly turnaround. John Fort sat down with CEO Pat Gelsinger and asked him about what is ahead.
Fundamentally, the four areas of our business, we're not changing any of those. A foundry, our client networking and data center business, those four areas. But within each one of them, we're looking at the portfolio of things and saying which ones are getting good financial return and which don't have as good a market or financial opportunity in the future.
All right, joining us now is Stacy Rascon. He is a senior analyst at Bernstein Research. I'm just going to, Stacy, you're a straight shooter. I'm just going to lay it out. You put in your note. You actually said in your note, I don't have it on top of my head, I'm not looking at it, something to the effect of, we may have to start having going concern comments or discussions.
Not quite.
No? Can you clarify that? Because it's getting a lot of attention.
What I said was in some other environment, we would probably be having those conversations. The one silver lining.
I want to be clear because it's gotten attention.
So what I wrote was in other circumstances, we would be having those conversations. However, the one silver lining from last night's report, I actually do think Intel will live through this. I don't know what kind of a life they will live, but they will live through it, and here's why. So they are clearly, things are going very badly. They're cutting a lot of costs. They're in survival mode. But if you sort of add up the cost savings from the reduced CapEx, from the reduced OpEx, from the suspended dividend, and then from all of the cash that's coming into the company, like from the governmental support, as well as some of these partnerships, they've sold pieces of some of their fabs to private equity and gotten cash in. If you add all that up, it's probably $40 billion of incremental cash that will be on the balance sheet by the end of 2025 versus had they done nothing. That will probably keep them alive. They'll be okay. I'm not really worried about going concerns given all of that. But in another world, if you didn't have the geopolitical
things to
concerns
sell,
and then all
but
the subsidies and everything, like we'd be having a different conversation. But I don't know what life they live.
If I have to sell my couch and to pay the mortgage and then sell my car, I know they don't have to. I get what you're saying. They're trying to bolster the cash position on the balance sheet. But you at some point, you run out of things to sell to private equity.
Again, it's hopefully they were at a point where it's enough. I mean, they've got a lot. I mean, they sold half of the Ireland fab to Apollo for $11 billion. They sold half of the Arizona fab, which is not operational yet, to Brookfield, I think, for $14 billion. So that's almost $25 billion just there. And, you know, given, like I said, the CapEx cuts and the OpEx, there's a lot of cash versus doing nothing. But, you know, like the state of the business is not good, right? I mean, they're burning cash. Margins are horrible. So the revenue's much lower than they thought. It's not a good situation.
So go more into that, Stacey. When you say it's not good, how bad is their business?
It's bad. So look, I mean, the quarter itself, the revenue you could argue was okay. The margins were awful, right? They're ramping up their new chips for AI PCs, and the cost structure is very, very bad. And so the margins are bad, and that actually gets worse as we go forward on the next quarter or so. Even into next year, margins don't look great. And then the back half revenues are much worse. So some of that is inventory drain. There's too much inventory on PC chips in the channel. We've been highlighting that. I monitor that fairly religiously. We publish on it every quarter, and I'm convinced that we're swimming in CPU inventory right now. I think they overship massively in Q4 and in Q1. I think on the data center side, like they're still losing share to AMD and it doesn't look so good. There are other markets, like Mobileye reported last night as well. We don't cover Mobileye, but factually they cut their guidance massively, and that goes in Intel's revenue. Altera looks like not great. That's their FPGA business. It's not good in the context of just the broader macro and the share situations and everything else. And because the cost structure is getting worse, like on just the cost of the parts, it's really impacting the gross margins. The gross margins are back to, they have a 3 handle on them now, which I was joking. The last time that was happening was 1986 in elementary school.
Well, now you're just bragging that you're younger than I am.
I'm not. I don't think I am. I was alive in 1974, so I don't think so.
Here's my worry as just a TV guy who's been doing this a while about Intel. Intel, and we wish them all the success in the world, was one of the most iconic success stories in global history, arguably. Everybody knew Intel inside, the little ding, ding, ding logo they had.
Yeah.
Obviously, things have gone wrong. My worry is that a lot of investors out there, marginally interested investors, are going to be like, oh, it's Intel. It's down 30% in 2 days. It must go back up again because it's Intel.
It's hard. I mean, I've been having that discussion all day with clients, like how do you value it? And the problem is there's no real earnings. There's no free cash flow, and there may or may not be any terminal value. Like we don't know, right? So, you know, I mean, look, tangible book value roughly is about $21 a share, which I think is where it's trading today. So I'm having those kinds of discussions with people. Again, I don't think there's any reason to own it. Like people that owned it clearly are selling it today. You've got probably a bunch of dividend funds who may have still owned it even after they cut the dividend last year, but they still paid one. They don't pay one anymore, so it's hard to own there. You know, it could go up too. I mean, it's down a lot. Like these things get really volatile. They start trading like options, like when the equity value gets low. So I don't really know what to do with it. But to me, it feels like you don't need to be there, like at all. Like I would be advocating avoidance at this point. Like, why do you need to be there? There's easier ways to make money.
There's a really easy way to lose money today if you owned it yesterday.
Clearly,
but we appreciate the candor and the honesty. Tough time for Intel, its people, and its investors. Stacey, thank you.
You bet.
Oh, by the way, so John Fort sat down, I don't know if it was earlier today or yesterday, with Intel CEO Pat Gelsinger. You saw some clips out of it. The full interview is going to air next hour on Closing Bell Overtime. I'm fascinated to watch and listen. I wonder if he's going to just say straight up to Pat Gelsinger, you seem like a nice guy, but are you going to step down? We'll find out. Tune in the 4 o'clock hour. All right, let's send over now to Kate Rooney for a look at some of the other big names that are moving into the close. Lucky you, Kate.
Exactly, Sully. A lot to talk about. Clorox is going to be one of the few green charts you see on your screen today. It's emerging as this flight to safety, leading the S&P gains, avoiding this market sell-off you've been talking about. Investors are overlooking some of the weaker than expected revenue to focus on the firm's strong profit picture. So the household cleaner giant raising its full-year profit outlook. And then, of course, household essentials tend to hold up better in any sort of economic downturn. And then on to one of the S&P's biggest laggards. You're going to see some red on your screen again. Shares of Snap. This is the parent company of Snapchat, sinking over 24% on disappointing guidance. The firm slashing its Q3 earnings outlook on soft demand from advertisers in consumer sectors. Brian, back over to you.
Hard to believe Snapchat was a $70 stock about 3 years ago, now under 10. Kate Rooney, thank you. All right, we are just getting started here on Closing Bell. Up next, we're going to obviously all over today's market sell-off. The major averages still getting hit hard into the close. And we have a great guest for you. Former Fed Vice Chair Richard Clarida back with us. We'll get his first reaction to the jobs number and whether recent economic data really puts recession risk on the table. Live from the New York Stock Exchange, Closing Bell. We're back right after this. All right, welcome back. Let's ask a very simple question. Did the Federal Reserve make a mistake by not cutting interest rates this week? More in the street are beginning to ask the question, especially as markets sell off today. So let's talk about the Fed's next move and where the American economy really stands right now with the perfect guest for it all, and that is Richard Clarida. He is former Fed Vice Chair. He is the Global Economic Advisor to PIMCO. And Richard, listen, good to talk to you again.
Yeah,
I know you have great respect. You have great respect for your former colleagues on the Fed, great respect and friendship with Jay Powell. You're not going to dunk on anybody. I get it. But was it a policy, personally, was it a policy mistake to not cut on Wednesday?
Well, I don't think so, and here's why. Look, the Fed is going to be data dependent. They've said that. The data's been soft for a while. It got more than soft. Today, markets have already priced in rate cuts. So I think the important point is the markets understand the Fed's reaction function. I think it would be a mistake if they didn't cut in September and probably indicate more are on the way. But no, I don't think you can micromanage July versus September, especially when the markets are doing some of the work for them.
Yeah, and that's you nailed it as usual. That last point, the markets are doing some of the work for them. We're all freaking out about the Fed and what they might do or may not do in September or November or December, whatever it might be. It looks like you're on the other side now, Rich. The bond market has spoken.
Yes. You know, and sometimes the market gets it wrong. In January, the markets thought there would be 6 cuts this year. Don't think that's going to happen. And then, of course, it got to 1 cut. So, you know, we're in a phase now. Look, there's been a big success here. The Fed brought inflation down from 7 to 2 point something. So far, we've avoided a downturn. I think the Powell Fed's trying to stick that soft landing, that soft, to borrow from an analogy to the Olympics. So I think that's where we are right now. Yeah.
So does it matter what they do in September? The market has got like a 100% chance of a rate cut. Does it matter if they cut in September for the economy? Yeah. And number two, you might have patched in late. I was sort of reminding the audience, Fed can cut any time at once, right? They don't have to cut only
sure.
meetings.
Oh, yeah. In fact, I was there. I was there in 2020. We did that a couple of times. Yeah, we prefer to call it an unscheduled meeting, not an emergency meeting. But yes, sure it can. I don't see that's happening. You know, there is a risk whenever the central bank adjusts outside of a scheduled meeting. The markets can think, you know, what do they know that we don't know? So no. But get back to your original question a moment ago. Yes, I think it would clearly be a mistake, given what we know now, if they didn't cut in September. You know, the unemployment rate has now moved up by about a point. The payroll gains today were very modest. You know, private sector payroll gains, especially excluding, you know, healthcare, which has a connection to the government, have been running weak all year. So I think they have enough information. They will have enough information going into September. I think they will cut. The news then will be how many cuts do they pencil in for the rest of the year. But they made it very clear in the FOMC statement 2 days ago that risks are bound. They have a balanced approach. They have two mandates: employment and price stability. And I think they're ready to adjust.
There's so much noise out there in the data, though, and I get it. I don't want to get politics involved, but everybody's like, "Oh, this super strong economy." I've been sort of on the tape saying I don't know how strong it is. Going back to pre-COVID, 6 million more jobs than pre-COVID. Divide that by the number of months. That's kind of average or even below average job creation. To your point, most of the job creation is either government or government funded, which is was healthcare. Those are good jobs. Yeah. No disrespect. I just wonder, can the private sector stand on its own? People wildly underestimate how much COVID money and COVID stimulus and low rates were out there. I just wonder what the actual stripped down, true American economy looks like right now. And I have no idea.
Well, I think it's a very good point. I have a similar set of sentiments in that I think this has been such an unusual cycle. The pandemic was unusual. The policy response, we had the Russia-Ukraine. You know, we lose count of not even getting involved in the political calendar. Very, very unusual. But in particular, you know, indexes of underlying strength in the economy, especially at the lower half of the income distribution, you know, have been slowing. And so, yes, I do think the economy is growing. I think it's growing at about trend, but the momentum is clearly downshifting. There is no doubt.
Yeah, and would a 25 or 50 basis point cut in the Fed funds rate when the bond market, to your point, is doing it already, is that going to change things? I went into it's like a recreational vehicle dealer, boats, motorcycles, campers, the fun stuff, but nothing we need, right? I was there last week in the Midwest, Rich, and I was talking to some salesmen. I also went to a car dealer. They were like, we're not selling anything. And everything was marked down. Cars are marked down. I get it. It's one stupid anecdotal thing. I just don't know if a small cut in borrowing costs is going to reverse that.
Well, there are 2 points here. One is the bond market's doing the Fed's job for it because the bond market is pricing in more than one cut. So I think they will have to be in alignment. Now, my view has been and continues to be the baseline is that the Fed's thinking that it can downshift rates, in tandem as inflation continues to fall. And I think that was a good model until the spring. But as we get closer to 2% inflation target, I think they've made it very clear, that they're prepared to adjust rates as the labor market softens. We've triggered the SOM rule as we discussed, and I think this is prepared to adjust rates even faster than inflation.
Why is everybody suddenly talking about the SOM rule? I heard of it for the first time like 3 weeks ago. I've been doing this 26 years, and suddenly it's like this magical thing that's come out of the air. Are you a believer in the SOM rule, son of SOM?
I know Claudia. I'm a big fan of her work. She was on
the 1 o'clock show today. She seemed very lovely.
Yeah, and no, the whole point of the SOM rule was essentially to find a simple measure of when the economy is tending to move from recovery, from expansion to a slowdown or even a recession. And the SOM rule historically has done a good job of identifying that inflection point. It might be wrong this time. We've had Chris Waller, for example, 2 years ago said, we can get inflation down without a big rise in the unemployment rate. A lot of folks said, you're crazy, that's never happened. Well, it has happened. And so this is unusual. This may be a cycle, and the SOM rule does not indicate a recession. But certainly, I think there's enough there that it's going to get and is getting the Fed's attention.
Great interview. I would expect nothing less, Rich. Thank you very much. Appreciate it.
Thank you.
Rich Clarity.
Very good.
All right. Very welcome. All right. We're getting some news, by the way, out of the Food and Drug Administration. Breaking news from Angelica Peebles. Angelica, what's going on?
Hey, Brian. That's right. We are just seeing that all doses of Eli Lilly's Mounjaro and Zepbound, those GLP-1 drugs for diabetes and obesity, are now all available. Remember, these drugs have been in shortage, not all of the doses, but some have been in shortage because there's just so much demand that they can't keep up with the supply. But now FDA is saying that these are available, and we're going to keep an eye out to see exactly what that means for Lilly when they report earnings next week. Brian?
Oh, so it's a good news breaking news, Angelica. It's not like a bad news breaking news.
No, it's good for Lilly. It's good for people who are looking for that drug.
Looking for that drug. There you go.
Those drugs, 2 drugs.
Raising their output, as we talked to the CEO in Indianapolis a couple months ago. Angelica, thank you very much.
Thank you.
All right, on deck. Call it crude realities. Even with the Middle East on the razor's edge, oil down today. We're going to find out why. Next. All right, let's talk oil and energy. All right, first up, we got earnings out of ExxonMobil and Chevron. Both were out today. ExxonMobil had one of its highest ever profits, yielded by Pioneer Natural Resources, boosting output. Now, Chevron did miss estimates. That stock, they're both down. Chevron's down a little bit more. Chevron missing mostly because of weaker margins in refining. And maybe a bigger headline, Chevron is leaving California after 145 years. Too high regulation, other issues as well. 2,000 people probably moving to Houston, California, losing another big company. Could be tough for the area. Now, also with oil prices are down today, even though tension is rising in the Middle East. And the real threat of an attack by Iran on Israel this weekend. Let's find out maybe why we're not seeing more of a pop. Bob McNally of Rapid Ant Group. Bob, I'm guessing we're not seeing a pop because you and I have talked about this many times. Unfortunately, in the last couple of years, there's always now some kind of a threat, and it feels like there's just plenty of oil to counter anything. We don't need to have $100 oil. What's your take?
Right, Brian. You know, the humans and the machines that trade oil are forward-looking. And when they look forward, they see macro calamity and risk. The unemployment miss this morning being the most recent example. They're very attuned to that. And that's why we saw crude sell off. When they look forward on the geopolitical side, they don't see anything. What they hear is the village boy crying wolf. In other words, you get these sporadic escalations between Israel and Iran. You get a little bit of a pop, like we got a few days ago, and then it goes away. And so, look, we're not disagreeing so much. I think the odds favor a sort of a bigger repeat of April. The Iran will strike back, but rubble will bounce, and most likely and hopefully Israelis won't die. However, the risk of escalation is not 0 or 5%. It's more like 35%. And you know, Brian, the village boy, who cried wolf, that story did not end well for the village or the boy.
Yeah, and that's it. And it's exactly kind of how I phrased it, speaking with somebody earlier today. There's a not 0% chance. And let's hope that none of this happens, Bob. But I guess the idea is Iran, literally Iran, maybe not even Hezbollah, launches a bunch of missiles like they did recently at Tel Aviv. Tel Aviv defends them. At some point, if that happens again, Israel will say enough is enough. And if they start to lay waste to some of Iran's money, which is pretty much all oil, what then with the price of oil?
It'll go up. The market will be shocked and it will go up. Look, the Houthis killed one Israeli in Tel Aviv with one drone. And Israel responded by torching the port of Hodeidah in Yemen, blowing up a power plant and storage facilities. So Israel's in sort of a 3 eyes for 1 eye mood right here. And so, look, just as the protagonist 110 years ago in Europe didn't want to enter a big war, a long, costly war. No one wants that. Iran doesn't want it. Israel doesn't want it. Certainly President Biden doesn't want it. But you can't always get what you want. And we are in an escalatory dynamic, and we're still climbing up those rungs.
Outside of that, let's all pray it doesn't happen, Bob. Fundamentals alone right now. Looks like the trend is lower for prices.
Yeah, fundamental data, Brian, coming in do not justify lower prices, in my view. Look at May. We got just hard data for May, blockbuster strong in the United States, including for gasoline, the highest since 2019 in May. We don't have any sign of a peak and collapse in demand there. Europe, not even so bad in gasoline. Yes, China. Yes, distillate is weak, but gasoline globally, jet globally, petchem globally, not weak. And we're seeing stock draws too. Brian, in Cushing and other places. So, look, it's not super bullish, but it doesn't call for a massive sell-off in oil prices, in my view.
Okay, good stuff. And obviously, we'll see what happens with OPEC December 1st in Vienna. Maybe we'll both be there. Bob, thank you very much.
Thank you.
All right, up next, call it an apple a day. Keeps the bears away. One bright spot in the market. Top Apple analyst Eric Woodring is here at Post 9, making the case for why there's still maybe 20% upside in Apple. All right, got about 18 minutes left to the close here. Not a good day. Macro markets down. NASDAQ down 2.5%. But one stock that is higher, not a lot, but it's higher, is Apple. Now, one analyst calling Apple stock a, quote, good place to hide in today's market. That analyst was not Eric Woodring of Morgan Stanley, but Eric Woodring of Morgan Stanley is indeed here. It's your competitor, but how much do you think there is today's move is more of like, yeah, let's put money in Apple because they're a safe place to be?
I think that's a very fair explanation. Again, what happened last night?
And not a knock on, it's not a knock on Apple at all. It's kind of the opposite.
We called it a flight to safety, right? Yeah. In a world, in a market where there's a lot of concerns of what's going on, both macro and micro-wise, especially with the consumer, Apple did slightly better than we expected as a market, right? They have a story to tell about what to look forward to. And in this environment, that was enough.
What is that story?
Right. So, again, iPhone 16 launch mid-September. What becomes really important is the iOS 18 launch. That should come in September as well, but then the incremental rollout of Apple Intelligence. The first time you're integrating generative AI onto the iPhone. Now, again, that's new software, but as we've talked about, what's important is you can only run that on the iPhone 15 Pro, Pro Max, and new iPhone 16 model.
I was just about to ask that because I got two phones here, and I just got a 15. It's not going to work on these, is it?
There's only 70 million iPhone 15 Pro and Pro Maxes out there today. There's 1.3 billion iPhones in the world that are active today.
So even if you're happy with your phone, and I'm sometimes happy with the phone, right? Pictures are fine, holds enough music's fine, works fine, whatever. If I really want that AI, I'm going to have to go upgrade.
You need to upgrade.
Is it going to be thus compelling enough that I will want that AI?
That's the magic question, right? That's what
we're all trying to answer. The magic question.
It's not out yet, so we need to figure that out. What we do know is developers have the first beta version of iOS 18 with a few features for Apple Intelligence today related to messaging, some transcription functionality. I would say the early reviews are positive, but it's still a very narrow set of features that developers have today. So we will need to wait and be patient for over time for that to roll out. Again, our thesis is fiscal 26 is the big cycle. That's 14 months from now. We're just saying that there's an upgrade cycle that is coming.
I don't give investment advice, but I will give financial advice, right? Sort of. Every couple months, I go a little crazy, and I go through the budget, the family budget, and I go through all the credit cards and everything, and I realize I'm sending massive amounts of money to Apple every month. I'm not talking about the phone. I'm talking about Apple One Plus, right? News and all this other stuff. Apple Music, iTunes Match, okay? Apps, Roblox, whatever it might be. It's a lot. I would imagine I'm not alone. Apple's services business is one of the biggest standalone, if it would be one of the biggest revenue companies in the world.
Correct.
It doesn't seem to get a lot of love or attention.
It should. It's outperformed for 8 quarters in a row. It's accelerating despite.
How much are they making off of the Woodring, Sullivan, and millions of other families? I was shocked at the money that was just going to Apple every month without me even thinking about it.
Well, I'll tell you two things. First of all, it's the power of the ecosystem, right? Everybody thinks phone, or iPad, Mac. There's an $88 billion business in services that should not go unnoticed. Again, 74% gross margin. That's incredibly important. But second, what's almost more important is today, the average Apple consumer across devices and services spends about $1 per day on the most important technology platform in their life.
On average, $1 a day.
I'm
well above that. But
spend $7.62 for a coffee per day in New York City. The amount of potential upside to spend per day that you could have for Apple, again, across the ecosystem, is incredible. Services is a key part.
Personal opinion, not representative of Morgan Stanley's views, Eric. Can they do something to make iCloud Mail not be so crappy?
I guess I will defer that question to the future.
I did not expect you to. I just had to. It made me feel good to say it because I think everybody kind of knows Gmail is far superior. They got to really work on it a little bit.
Sure.
But we're still handing over.
We are
handing over that money.
Again, Apple did what they needed to do to help investors feel better about owning Apple stock, and you're seeing that today in the market.
That's it. A good place to hide also. Eric Woodring, Morgan Stanley, great combo. Thank you.
Brian.
All right, still ahead. Trouble in tech. Amazon's post-earnings drop dragging down the major averages. NASDAQ on pace to close in correction from its record high in July. More than 10% drop. They call that a correction, and we're getting ready to go into the market zone. thankfully, on a Friday after this. And we are now in the closing bell market zone, the last one of the week. Charles Schwab's Kevin Gordon is here on what is a very volatile day for stocks. Leslie Picker is tracking some of the bank sector sell-off. Surprised I got that out. Kate Rooney on Amazon's post-earning drop, one of their worst days ever. We got a lot more to do and not a lot of time to do it. So let's just jump right in. Kevin Gordon of Schwab, thanks so much for being here.
Nice to see you.
What is the biggest question you are getting from clients right now?
Well, I think one of them being, is this more of a shift out from, what's become this kind of positioning argument? Things got too one-sided for the mega caps, and maybe shifting into, are recession fears now more justified because of this one jobs report? It is a little amazing to me to see so much focus on one report itself. And of course, yes, the broader context is that things have been slowing in the labor market, but I'm not sure we should be, having so much of a knee-jerk reaction to just one, especially with the aggressive nature of the drop in risk assets. But I do understand why it's happening.
And go into that more. Listen, you are the expert. I am not the expert. But I can tell you this. I'm doing a long time. I have not seen a market move like this because of a small miss in the job market, or maybe the Federal Reserve should cut, 2 days ago instead of 2 months from now. Every guest we've had on is like, this is positioning, it's technical stuff, it's carry trade, hedge funds. this is not mom and pop selling, is it?
Well, I think you have to keep in mind where we were, coming into this with, the investor sentiment environment was incredibly frothy. You basically got back up to, kind of all-time highs if you were looking at a combo of behavioral and attitudinal measures of sentiment, but also the fact that, you had this really strong rally and sort of the snapback in the rubber band on the small cap side because of what happened with the June CPI report. Now, of course, a lot of that is reversing, but I think that in conjunction with what had been from a positioning standpoint, a lot of this trade kind of moving into the mega cap world at the same time that you started to see this breakdown in breadth under the surface. So a lot of this and how we're kind of looking at it is, the indexes from a volatility standpoint catching down to what had been weakness sort of under the surface. Because you have to keep in mind, too, up until this point, the average max drawdown for members in the S&P was approaching 20%, getting up to 16, 17%. For the Russell 2000, it was more than 30%. The max drawdown at the index level has really not been that bad this year for the S&P, for the NASDAQ, for the Russell. You haven't even yet gotten to outright correction territory. So I think a lot of this is the index is kind of catching back down to what has been the story under the surface.
By the way, not even the worst day of the year for the S&P. That was July 24th, where we fell 2.3%. But here's what does not worry me, it vexes me, which is that the rapidity of these moves now, even though the market's gotten faster every day for 20 years, I get it. But when small caps gain 11% in 2 weeks, and Nvidia is down 25% off its high of a month and a half ago on no news, by the way, and we have two of the worst days of the year in the same 2-week period, it just feels like everything is a lot more violent these days.
Even for small caps, though, I mean, you have to. The other thing I think it's important to point out is a lot of the move that you had seen post CPI, and I think the excitement around the fact that the Fed was finally getting ready to start cutting rates. I think a lot of the excitement was just kind of a delayed reaction because the one unique aspect, I think probably the most unique aspect, at least of this market cycle, especially when you look at prior tightening cycles, when you look at prior bear markets, full bear market cycles for the S&P, the period of October 2022 to October 2023, the first year of the bull market for the S&P, the Russell 2000 was flat.
Okay.
A few days after that, actually broke through its low from 2022, which has never happened before. So I think a lot of it has been a delayed reaction and kind of hopes of small caps finally getting to start moving again. But now that's being sort of blunted a little bit because of the growth scare that has crept back in. I think a lot of it too is the question now, not whether the Fed goes in September, but the decision between 25 basis points and 50 basis points. That reintroduces some of the risk that it's a panic kind of cut and they have to sort of catch down to the economy.
If they did the rare intra-meeting cut, that would be the panic cut. Sit tight. We'll get into that. Kevin, don't go anywhere. We got a lot of stuff happening. Leslie Picker, I'm looking at my little FactSet screen of all my bank stocks, hundreds of them. There's 4 financials and banks that are higher. The rest are lower. Brutal day for the market.
Yeah, absolutely brutal, Brian. You've got those steep declines among banks today, helping drag down that financial sector to be the second worst S&P sector today. Citi, the laggard among the big 6 U.S. firms, slumping more than 7%, followed by Wells Fargo. It's a partial reversal in the strength that this cohort has seen in the year through July, with each bank over that time frame up at least 20%, except for Morgan Stanley, which was up about 11% during that time. August has been less friendly to the sector, though, which is levered to the health of the economy. Cracks in the soft landing narrative would be a headwind for everything from investment banking to consumer credit to wealth management. Additionally, a steeper magnitude of rate cuts could ultimately compress what banks are able to charge for loan making. And on top of the macro issues, some banks facing their own idiosyncratic headlines today as well. Morgan Stanley downgraded today to underweight by Mike Mayo over at Wells Fargo. Berkshire Hathaway sold even more of its stake in Bank of America, and Wells Fargo appears to be the subject of a new regulatory probe, Brian. So it's kind of like bad news on top of the bad macro news, just all kind of hitting this sector pretty hard today.
Can't wait for your conversation with Mr. Jamie Dimon out there in some place called Kansas City on Wednesday. It's going to be great.
Good timing, yes.
It's perfect timing. Bring back some barbecue. Leslie Picker, thank you. Let's talk. Speaking of getting barbecued, Amazon's down about 9% today. Kate Rooney, what's going on with Amazon?
So, Brian, Amazon, as you can see on the screen, it's one of the biggest laggards, the biggest laggard actually on the Dow. If you look at just the Dow, today. It has to do with these jitters around the consumer and this choppy forecast we heard about for the third quarter. And you step back for a second, Amazon was really seen as this hedge in mega cap tech because it also had the consumer business. It wasn't just an AI play, but that is working against the stock today as investors now worry about the broader economy. As you've been talking about, revenue guidance missed for Amazon for the first time in almost 2 years. Profit outlook also came up short. And then online sales growth did slow. CEO Andy Jassy on the call with analysts called the consumer cautious. He noted that folks are now trading down to lower priced items. Cloud growth, though, that AWS side of the business, revenue there was up 19%. It was better than expected. Amazon does plan to spend more this year after spending $30.5 billion in the first half. Company now expects capital investments to be higher in the second half. They say the majority of that spending is going to be for AWS infrastructure. And, of course, AI, Brian. Back to you.
Of course, AI. I got to say AI every day. Kate Rooney, thank you. Kevin Gordon, final wrap. Listen, it's going to be a big weekend for Schwab.com. Your clients are going to be going there to read what you and Liz Ann are writing about. Can you give us a preview? What kind of advice are you giving people here out?
Well, I think, as it pertains to the Fed cycle and actually some of the sectors that were just covered, both of them, whether it's financials or Amazon and, consumer discretionary, what has become important, I think, is the now shift maybe in the narrative, whether it is now it's a potential shift. It's not a definitive shift, but if the Fed starts to go into an aggressive cutting cycle, because there is, there's a lot of variability when you look at prior Fed cycles and you look at market action, but one that is a little bit more consistent is when the Fed does get more aggressive, when you've got more than 5 or 6 cuts within a 12-month time span, it tends to benefit the so-called, traditional defensive sectors like consumer staples or utilities or healthcare at the expense of the, quote, rest of the market.
Utilities,
everything that
they were up today. I don't know if they still are. Maybe we can throw the XLU up while we have 30 seconds up.
So I think that's going to be part of now the discussion as to whether they're, again, catching, down to where the economic data, and if they're being pushed around by the economic data, or if they're able to still sort of, take it at their own pace and really signal that things are relatively okay. I think then the cyclical trade broadly can hang in there.
Well, Kevin, you're more than okay. You're great. We appreciate you coming on. Have a great weekend here. We got a lot of cheering for the Hong Kong Dragon Boat Race Festival. A lot of smiling faces, not in the market, but up there. Folks, I've enjoyed being with you. We'll see you next week. Let's go into overtime with Morgan and John.
A major sell-off rocking investors today after soft jobs data dialed up fears about the health of the economy. Tech getting wrecked, dragged by huge pullbacks from Amazon and Intel on earnings. That is the scorecard on Wall Street, but winners stay late. Welcome to Closing Bell Overtime. I'm John Fort with Morgan Brennan.
Well, we will be all over the market downturn throughout the hour with a great lineup of guests to break down whether this is a buying opportunity or just the start of more selling.
Plus, we'll have much more on Intel's free fall, including highlights from my first on CNBC interview with Intel CEO Pat Gelsinger. But first, let's start with the markets and the sharp sell-off sparked by soft earnings results and much weaker than expected jobs report. Let's bring in our panel. We've got Unlimited CEO and CIO Bob Elliott, because it's Friday. Love Friday, Bob. And CNBC senior economics reporter Steve Leisman. Guys, welcome. Steve, okay, this started with the jobs data in a way, so I'm going to start with talking to you about that. All of a sudden, bad news, bad news. What is it in this data that you think might have changed the narrative so much?
Well, can I just back up just a little bit? Because I think the context is important here. I think that we came into this week. There's been some rethinking about the valuations in some of your stocks, the ones that you screwed up, right, and went too high. Okay?
I don't own them. I just talk to a lot of
you talk to these people,
yeah.
And it's like, wait a second, where's the profits coming from? I think point number 2 is that the earnings and the revenue have not overall in the S&P been that exciting. And it raised more questions about broader valuations. Now you come in, this is the third leg here. And we've had some gathering weakness in the economic data this week. The ISM manufacturing numbers were terrible. The jobless claims ticked up. And now this number. And the problem with this number is there's nowhere to look to sort of hang your hat on if you're an optimist. It's pretty relentingly weak all throughout. The only good thing, two good things you could say. One is that there wasn't a lot of firing. There was just not a lot of hiring. what happens over time with that is you end up perhaps losing payrolls, losing gains. If you don't, there's a lot of churn in the job market. So what happens is, in fact, it's like looking at the surface of some lava and it looks flat, but underneath there's all this stuff going on. People are losing their jobs all the time in industries. People are gaining their jobs. What happens is it looks flat across the surface, but right now we're just getting we're not getting a lot of hiring, but we're not also getting a lot of firing yet. But we'll